Alright, so to follow the theme the last time I did this video, now it's 6 days of lower highs and lower lows. 5 of those days being down days, but also 5 days in a row of closing above the previous day's low. So an interesting pattern that we have on this pullback heading into support. Is there more pullback coming next week? Are we going to bounce off of this? I'm going to break that down in today's video, as well as finding a pocket of weakness where we can make a trade. Let's go ahead and get started. Today is Friday, September the 7th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Glad to have you. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo right here. Then click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That lets me know two things: that you like the video tonight and you want us to do it again Monday. Really easy way to give us feedback. You can do that right now while you're watching. Comment on anything that stands out to you in tonight's Market Outlook video. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to join our list. Really easy way to do that. Follow me on Twitter for more content like this throughout the day and throughout the week. And join our Market Outlook community that we have on Facebook. All right, well, let's take a look at the market forecast first with the the S&P 500 first with the market forecast indicator. You'll notice that we have a weak bearish posture, so we have pink shading finally. And we talked about before that at some point in time we're going to get pink shading to set us up for that seasonal end-of-year rally, especially with the 5-month winning streak that we had and the strong January that we had. So we haven't had dark pink shading since over here. This is the intermediate rally, the current rally that we're on with the Fibonacci lines. You notice this little 6-day streak of lower highs and lower lows, but closing above the previous day's low. 6 days in a row now for that. Got us down to the old January high point, which happens to line up with this 23% Fibonacci level. You can also see there's a near-term high point right here, about in that area. There's another near-term high point right here, and I'm just looking at the peaks, and the blue lines are right there. So we've got a couple near-term peaks in this area that can act as a support level as we pull back. And also remember too, as we pull back, we're pulling back into areas where there is some, we have some volume nodes kind of in this 283 area, or the 38% Fibonacci retracement. Of course, the 50% retracement's right here at that volume node. So we've got a couple of volume nodes sitting right on Fibonacci support, and of course we're right here at this kind of more minor node where these near-term peaks and this old January peak happen to line up. So if we don't hold support at this area, there's lots of support at each one of these Fibonacci retracement zones that can hold us up. And if we were to come down to either one of these areas, then we would set up for a good bounce because it would be a much higher low point here than the last intermediate low point where we had dark pink shading over here. Remember, to get the dark pink shading, the green line has to fall below 50. We've had a 2-month run, 2+ month run. It's not over yet. It doesn't end with light pink shading, which is what you get when it's falling below 80. It ends with the dark pink shading. So, we've had light pink shadings twice during this current rally. So that's what we have right now. Again, like yesterday, these short-term sentiment lines were actually a lot lower intraday, and they finished up a little bit higher. So a positive sign there. You can see the Dow Jones Industrial Average has not pulled back nearly as much as some of these other indexes have. Remember, it's not up to its new all-time highs yet either. It's still showing a strong bullish posture because the intermediate line's above 80. The near-term line fell, but not below 50, so still in the upper half of the chart. Kind of keep an eye on that to see if that ends up being the peak for the near-term line. You look at the NASDAQ composite, and you'll see it's got a weak bearish posture with short-term sentiment, kind of oversold short-term sentiment. You can see the last near-term low points here. So, and there's the old near-term peaks in this area. So we haven't even broken, these pullbacks haven't broken prior near-term peaks Right, remember, we're coming down from a higher near-term high, and we haven't broken below the previous near-term high, much less the previous near-term low point where we start a new bearish trend. And you can see the Russell 2000, same exact thing. There's the break, there's the consolidation triangle that we broke out of, and right now we're still kind of sitting on the old high points during this oversold pullback here, with the near-term line dipping its toe and actually still showing strong bullish posture. So another intermediate confirmation signal with the strong bullish posture and oversold momentum line heading into a new week. All right, before we look at other charts, a quick reminder that you can watch our video here on our blog. There's the link to the video here where you can watch it. Remember, we asked for 3 clicks. If you want us to do it again Monday, we asked for 3 clicks. One is right here to click on that heart on today's Market Outlook tweet. Opens up this new window where you can like tonight's Market Outlook tweet. 2 is to click on this image. Takes you to your Facebook page where you can like tonight's Market Outlook post on Facebook. And then finally, the third one, clicking here. Remember, you can participate in a discussion about tonight's Market Outlook forum by clicking on this link. Be able to see any questions or comments you have there and participate with you. There's our class schedule we have coming up. This is tomorrow's Q&A session that I have on Saturdays, as well as next Monday's classes. And of course, to participate in the forums, you have to subscribe to our site. You can do that for free by clicking on this image here. I have to admit, I laugh because it seems like I'm always trying to convince people of bullishness. Of course, that's just what the chart's showing, so I can't make up bearish charts right now. But I will say that it does seem harder to convince people to be bullish and stay bullish as we climb a wall of worry. Much easier to convince people to be bearish. In fact, a lot of people are already trying to convince me to be more bearish. So, I mean, this is all it takes to try to convince people to be bearish. It doesn't take very much. Whereas, a lot of people, it seems like we've been more bearish than bullish, even though the trend of the markets have been higher. We're towards the end of a second intermediate rally of higher highs and higher intermediate lows for the last so many months. So if it seems like I'm trying too hard to convince you to be bullish, just keep in mind it's harder to convince the markets to be bullish, even if the trends themselves are bullish, than it is to convince people to be bearish. Because like I said, all it takes is a near-term pullback and the bears come out of the woodworks, right? All right, let's take a look at the long-term view, the long-term chart, and you can see bearish candle. You remember how we said last Friday that we were so far up above these moving averages that, at best we'll start to flatten out and let these moving averages catch up. I showed you the MACD with how far above the 50 we were, how far above the 200 we were. Well, we got a bearish candle on the Hakinyashi. We've had a candle like this a few weeks ago, but we did get a lower, a smaller body, kind of like a Harami pattern forming here on the Hakinyashi. So potential. This would be a big time bearish divergence. We obviously are at higher highs and higher lows. From a long-term basis, that would set us up for a move down to the downside if and when we turn bearish, right? At some point in time, the long-term trend will turn bearish, and if and when it does, and this divergence holds out, that's the mark. Now, keep in mind, it took for this divergence to play out here. Or even this one here, it took about a year to play out for us to finally test that low point here in between. So and even this low point here in between this higher high and these lower highs, to test that low point, you notice it took, that was 14, 15. It took almost 3 years to test that divergent low point between the highs. So even though we might be setting up for a bearish divergence here, we're not talking about next week or the week after that. It could be a year or two or more before we finally come down to that low point. And you can see, we had a bullish trend for so long while we were diverging before, bam, tested it. Bam, tested that one in a matter of like a few weeks. All right, you notice we are getting 2 red arrows. You know, this isn't the first time we've gotten 2 red arrows on this current intermediate rally, right? In fact, we had 3 red arrows in the middle of that intermediate rally. Then there's the intermediate pullback here. And then we've had 2 other sets of 2 red arrows here. So this isn't the first rodeo for a pullback on this current intermediate run. If you take a look at the 2-line versions of this, you can see that we are still, I mean, we haven't really even tested the 30-day moving average. We're still kind of testing the 17-day moving average. The 8-day is still above the 17-day, even if we are losing some of that positive momentum. But again, we've lost positive momentum before, only to regain it and get back up to that 20 level. Same thing with the stochastics. We've seen this picture before. Not that we won't go down. We could definitely go down here and get that intermediate pullback again that we got here. And you can see how different the intermediate pullback is from these pullbacks. So that can definitely happen. What I'm saying is it doesn't have to happen, because we've seen the last couple of pullbacks did not turn out that way, and we just got another bounce and heading up higher. In fact, Brandon tweeted out here. Here we go. Brandon tweeted out that we hit, even though we have strong highs, we hit 56. You can see there 56 new lows within the Market Scholars 1000 this week. We've hit 50 before the week, the week that ended 8/17. This is a Friday, and then you can see right here 6/29. We also had 52. So this is the 3rd time in the past 3 months. Well, if you look at early July and then mid-August, if you go back to the chart, well, here's that early July, so we bounced off of there, and then there's the mid-August. We bounced off of that and had that run. So are we going to get another run like this or this heading into off of this level? Again, not that we will bounce, not that we won't go down, but we don't have to pull back as much as the bears would suggest, or even for that matter, the headlines would suggest, because we've been, the news and the sentiment has been this dire before, only to see us bounce right up off of it. I did fail to mention that the weekly chart on the market forecast got a bullish intermediate confirmation signal. So we got a drop on the momentum line. You can see when we get the drops in the momentum line this far, here's where we had a big time reversal. That was at the end of this, 5-month intermediate rally. But you can see all these other times we get these intermediate confirmation signals, we tend to bounce, if not the next week, the week after. So we'll see if that ends up being the case again. We have had, a pretty decent near-term run on the weekly basis. So we might be kind of towards the end of this current near-term week. So we might get another week of selling that might pull us down to that 38% Fibonacci retracement, maybe that 50%. But then, again, with the intermediate posture strongly bullish on the weekly chart, we'd anticipate a bounce. So we might get the near intermediate line on the daily chart pulling back below 50 and showing that dark pink shading. Would not be the end of the world. In fact, would be a good thing because of the buying opportunity it would represent. It will not seem like a buying opportunity at the time because, like I said, the bears will come out of the woodworks. The news headlines would most likely be very dire in terms of tariffs or whatever. There will be, the market sentiment will be fearful, and that usually ends up being the times to be the buying opportunities that we find. All right, now let's take a look at the intraday chart. Again, you can see how for the 6th straight time, lower high, lower low, but we closed above yesterday's low point, and we closed above the open. So again, you can see that this is the weekly Hakinyashi, the open price for this week. We basically closed right on it. So a little bit of a lower shadow on that weekly chart, very small body. And again, you can see this, we'll have a few days next week where this will still be the midpoint. So we're still trading in the upper half of the chart despite the extended pullback here. Still trading in the upper half of the chart. You can see why we're kind of holding support in this area from this old level over here, holding up on an intraday basis. You look at the volume and the trading range today, you say, okay, well, we're getting a bearish volume. We did get 73 million shares traded, a little bit above average, and the volume today was 1.99, so right at the average. So let's put that into context. 73 million shares is right about a little bit above average, so right there. So you can see where that, how that fits with the 52-week range. Again, 100 to 125 million would be the bearish volume that we just haven't gotten any of these days. 3 to 4 points would be your bearish range. Again, we were just barely under the average, and that average is still easily below 1%, which is bullish territory. So we got to get above 1%. We got to start having multiple days in a row with above 1% ranges to get this line to start coming up. This is the bearish territory, and we're just not getting that during this pullback. All right, and finally, let's take a look at the volatility levels. Volatility, again, getting up to 15, not breaking significantly through, like even we did over here in the middle of August, where we had all those lows, the plus 50 and the 52-week lows. Well, look at it on a relative basis here, and you can see we traded within the lower end of the neutral range here at the end of this week, but we're still below the neutral range. We closed the week below that neutral range and just at the upper end of the bullish range. So again, kind of hard to be too bearish when volatility is not spiking up towards 20, when it's not up above into the bearish territory, and when we're just not getting the big volumes and trading ranges to tell us to be bearish. All right, so what do you think? Do you agree with that posture? Do you disagree? I mean, we're kind of at an inflection point where there definitely could be a lot of disagreement. Let me know by clicking on that poll that's popping out in the top right corner of your screen. If you disagree and are more bearish than this, let me know. Scroll down to the bottom, comment below. Don't just tell me, oh, you're an idiot and you should be a lot more bearish than this. Let me know what you're seeing. It's definitely a opportunity to share with each other amongst our market outlook community, market scholars community here. What you're seeing that would suggest that we should be anticipating a much more bearish pullback than what we're currently seeing. Again, you can do that down below on YouTube. You can also do it on the forums and market scholars with that link that I showed you earlier. All right, now let's talk about what's driving the price action today. Of course, the biggest thing that was impacting the price action today was the jobs numbers. Jobs numbers coming out well above, and not well above expectations. Remember, we're getting to a point where unemployment's so low. The growth rate here, the year-over-year growth rate for jobs, it's going to come down. It had been coming down. It's hard to maintain such solid growth rate when everybody's already employed, right? So eventually, this participation rate would rise. It fell down a little bit here, but you'd expect it to rise as more and more people come into the workforce that have been either marginally attached or quit it during this past recession. So you expect that to rally, more people come in. So that's how you get the marginal growth once you get down to these really low levels. And you can see that's been the case really for most of this past year. It's been a gradual move higher on the jobs. Even if the last few months have been relatively lower, still maintaining 200 plus, close to 200,000 new jobs a month. So again, this is how to show you how low it's gotten. It's pretty much almost cut in half from what it was just 5 years ago, the unemployment rate. So that was the big news today. Nothing really else coming out. Tariffs, especially late in the day, tariffs, or middle of the day, tariffs with China, with the U.S. proposing or ready to impose more tariffs on China. That news came out and that the stock sold off. It's pretty much to yesterday's low before bouncing into the end of the day. You can see the economic indicators have bounced up. We're not as negative as we were. We were down close to negative 20. We're only down to negative 3 now. In fact, the G10 Economic Surprise Index is positive. That better than expected jobs number really rallied up interest rate hike expectations. In fact, this is for March now. So the two here in September and December are pretty much baked in the cake now. December is now up to almost 80%. Being just over 70% yesterday, and you can see about 70% a month ago. So not a lot's changed there. What's changed is this March. The March now, which 250 would be the first rate hike in 2019, the odds jumped from under 40% to almost 50% right now. And you can see, just a month ago there wasn't a whole lot of change there. This has been the biggest change. So a lot of this coming from the rise in the weekly wages that we see here jumping up. So we'll see the impact that had. Obviously the dollar was the biggest gainer today, but you can also see commodity price, even with the trade war winds blowing, agricultural commodities, which have been really beaten up on that news, didn't continue to fall. So that was a positive development. Commodities as a whole, with the strong dollar, still holding up well. On the other end, look at long-term bonds, and you can see international stocks continue to underperform the U.S. stock market, and you can see growth and value up here. IWM really outpacing, so it wasn't really a risk-off move. High-yield bonds doing well today. Where's the junk bonds? There's the investment grade down here. So high-yield bonds, junk bonds outperforming. So again, not a risk-off day per se, but that long-term bond, you can see if I were to go to the weekly chart here and take a look at the 10-year yield. A little bit of a bounce up. We had broken down below that line. We had that divergence there. A little bit of a bounce higher. Obviously not back above 3% yet, but a good bullish candle nonetheless. And you can see again, a bullish after having a few bearish weekly candles, bullish candle on yield. So we'll see how long that lasts with this kind of head and shoulders pattern that we had been forming, developing there around that important 3%. Remember the 30-year bond, more reflective of economic growth expectations. It had a bullish candle too, but a lot further away from that important kind of 3.25% level that it would have to get above for us to really take a bullish move seriously here. If you take a look at the foreign markets, again, the markets that were beaten up the most, these emerging markets with the currency issues in Turkey and Argentina, they continue to bounce up the most here. Brazil kind of coming up too off of 3-month lows. And there's Indonesia, also another area that have been struggling lately. They've all gained. So again, EEM doing pretty well, and then S&P 500 lagging behind those, but beating everybody else, especially European. You can see Japan close to its 3-month lows, Germany close again to its 3-month lows, France close to its 3-month lows, the UK at new 3-month lows. So Russia forming a third consecutive oversold cluster, Canada at its 3-month lows, and with all of that, as bearish as that is, the US is pulling back to Fibonacci support. So it kind of gives us some perspective on really how bearish we are right now and how bullish things can be if these other areas start to turn around again. Usually it's the other way around. Usually we are the ones that drag them down, not the other way around. Now there could be some currency contagion in some of these areas, but if there's any contagion coming from Turkey and Argentina, it's not hitting us yet as much as it's hitting these other countries. So if we're able to maintain strength, that actually might be a positive for these areas to eventually bounce off and get some of their own strength, which would subsequently be a positive for us. We won't be at the top of the list when everything bounces. We'll be down here, but we won't be negative when everything bounces. We'll be kind of being dragged up along with them too. That might be the macro backdrop that provides the bullish environment for the seasonal move we expect at the end of the year into the beginning of next year. All right, when you take a look at how the sectors performed today, discretionary healthcare, healthcare has been one of the strongest sectors, maintaining that strength. Not everything has been bullish. You can see energy, materials struggling. There's materials down here. Energy holding up well today. Real estate and utilities got beat up the most today. They've been relatively bullish, but they're weaker in a higher yield environment with yields bouncing up as much. You can see technology pulling back. This pullback has been mainly fueled by the sell-off in technology. You can see here the new communication services sector with stocks like Facebook in it, Netflix, and Google That would be dragging that down. You can see these other weaker sectors, energy at 3-month lows, materials sideways, financial struggling to maintain even with higher yields, which tells me not to put a whole lot of stock in that higher yields. In fact, the yield curve is actually pulling back even with the jump in yields, because the shorter term yields jumping up more. And you can see industrial still strong bullish posture, healthcare strong bullish posture, discretionary strong bullish posture, all above 80 still. Again, you look at this chart over the last 3 months and you can see the strength has been in utilities, and here's staples, real estate outperforming too. So there's some pullback for that to occur in these strong areas, whereas you have some relative strength here in healthcare, and then you can also see industrials lagging but starting to make a move higher. Still some weakness in energy materials. There's opportunity there, but not until the dollar starts to drop, right? Not until you see more of an extended move here to the downside in the dollar, and we're not seeing that, right? Today we had a little bit of a bounce, relatively bearish candles, but not bearish enough to say, you know, we got a bearish trend going. When you do, then you'll see strength in these areas at the bottom. Oh, not. You can see them down here, materials and energy, but then you'll see strength in this one. Down here, here's materials, and then there's energy. You would expect them to bounce up, and you'll see stuff like utilities and real estate pull back at that point. Industrials too, you'd expect, which has been underperforming. You see, it fell down here along with financials and materials. It was really, really weak. Industrials during that drop here in late June, but you know, since that low point, it's actually done pretty well. See, materials have stayed down, but industrials has been bouncing along with some of these other areas. So there's going to be some opportunity there too in that industrial sector that's been slowly working its way away from the bottom, which is where it was, towards the top of Brandon's sector selector rankings. All right, one pocket of weakness we have in this home builder sector, which we had this kind of divergence, you know, lower highs in the MACD and lower highs in the stochastics, but a higher high, kind of a failed breakout move here at the middle of August. Well, now we're coming down in a big breakdown today, so you can see how we broke through these lows back here in these areas. MACD crossing below zero, stochastics crossing in the lower half of the chart. Decent volume, not 1.5 times, but close, and definitely higher than the volume we saw on all these days except for the failed breakout day. So bearish candles and a bearish move. You can also see it too on the Bollinger Bands. If you pull up the Bollinger Bands here, kind of breaking down from a volume node, a big volume node, and the biggest area of volume that we had, breaking down below that into this kind of vacuum of volume. So not nearly as much volume down in this area. So an easy move to get down until you get down to this area of low volume, the bottom end of the 70% range, right there about 40. So the getting to the lower Bollinger Band with low bandwidth, and then you look at like the DMI, the negative DMI crossing up above 25, so a bearish breakout there with a decent volume. You take a look at the long-term charts for this, and you can see there's that upper shadow, another even upper shadow this week. Not able to really bounce off of this. We had broken below the 200-day moving average. We tried to regain. We're unable to, and now looks like we might. You can see the MACD is barely up above zero. Now looking like we might get back down below the 200-day moving average there. So with that said, we can look at selling options, of course, on this. If we sell that 30 delta, sell the 45, buy the 47, you can see getting right around the 47 cents is what we'd prefer. But try to get in that area, 30% return on risk. Decent odds of success, and you see whenever we put that break even on the chart, and let's go back to just like a 3 green arrow chart for DHI, you can see that we'd have to essentially reverse this breakdown that we've had, right? Because there's the break even up there, and of course we can let it go a little bit past that because we're willing to lose what we're trying to make, about 46 bucks before we get out of this. In other words, getting out at about 92 cents or so. So an opportunity to make a quick bearish trade in a pocket of weakness in case there is more of a pullback in the markets over the next little bit in the September swoon. All right, so what do you think about the trade idea tonight? What do you think about the market posture, market outlook? Now I want to hear from you. Use the link popping out in the top right corner of your screen. Click on that. It will take you to our Market Outlook forums. Love to hear from you on any comments you have or any questions you have about something I talked about or something I haven't talked about. You can comment in there. Remember, you have to subscribe to our site to be able to participate in our forums, but you can do that for free with the process I showed you earlier today. As always, thanks again for watching. I hope everybody has a great weekend. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment. Follow me on Twitter for more content like this, and join our community on marketscholars.com as well as on Facebook. Have a great one, everyone. We'll see you next time.